You get a $5,000 client payment. It lands in your checking account, same account you pay rent from, buy groceries with, order takeout on a Friday night. 3 months later, tax season hits, and you're staring at a bill you have no idea how you're going to pay. That money already left. You just don't remember spending it. If you're a freelancer, contractor, or small business owner who invoices clients and gets paid in lump sums instead of a steady paycheck, this is for you. Not your 9-to-5 friend with direct deposit. You, the person whose income shows up in unpredictable chunks and somehow always disappears before you can plan for it. Today, I'm showing you the exact system to stop that from happening for good. This isn't about budgeting harder or feeling guilty every time you buy coffee. This is about building a business that runs on structure instead of stress, so you always know exactly what's yours to spend, what's owed to the IRS, and what's building your future without the panic. Here's the truth almost nobody tells freelancers. When you're self-employed, there's no HR department taking taxes out before the money hits your account. No employer matching your retirement contributions. No steady bi-weekly deposit you can build a budget around. It's just you, one bank account, and every dollar you earn showing up looking exactly the same, whether it's rent money, tax money, or profit. So what happens? You get a great month, a $6,000 or $8,000 invoice clears, and it feels like a windfall. You breathe easy. Maybe you upgrade something, treat yourself, catch up on bills you've been putting off. Then a slow month hits. Clients ghost, projects get delayed. Invoices sit unpaid for 30, 60, 90 days, and suddenly that great month money is gone, and there's nothing left to cover the gap. And underneath all of it, quietly compounding, is the tax bill you're not setting aside for. Because if it's sitting in the same account as your rent money, your brain doesn't treat it as owed money. It treats it as available money. That's not a discipline problem. That's a systems problem. And today, we fix the system. If you don't already have a business bank account completely separate from your personal one, open one this week. Every client payment goes into the business account first. Not your personal checking. Not your personal Venmo. The business account. Right now, if you're mixing funds, your brain has no reference point for business money versus my money. It's all just money in the account. The moment you separate them physically, your brain starts categorizing automatically. You start asking, is this a business expense or a personal one? Instead of just swiping a card and figuring it out later. This single move is the foundation everything else in this video depends on. Say you invoice a client $3,000. Right now, that $3,000 lands in your personal account next to your rent, your Netflix subscription, and your grocery money. It's invisible the moment it arrives. Once you have a business account, that same $3,000 lands somewhere separate, and it stays business until you deliberately decide to pay yourself, which is exactly what comes next. Inside your business banking, set up 3 separate accounts, or 3 clearly labeled savings buckets if your bank allows sub-accounts. An operating account for business expenses, a tax account for money owed to the IRS, and a profit or pay account which funds your own paycheck. Every single time a client payment comes in, you immediately split it across all 3, using set percentages. This is the single biggest shift for freelancers because it kills the "it's all just business money" confusion at the exact moment cash enters your world, before it has a chance to get spent on the wrong thing. Instead of figuring out taxes at the end of the year in a panic, you're paying yourself in real time, invoice by invoice. Let's say you get paid $5,000 for a project. A common freelancer split looks like this. 50% or $2,500 stays in operating to cover business costs like software, contractors, and ads. 30% or $1,500 goes straight into your tax account and never gets touched for anything else. 20% or $1,000 goes into profit, which becomes the pool you pay yourself from. The second that money hits your account, it's already been divided into what it's actually for. There's no more guessing in April. Stop pulling money out of your business account randomly whenever you need cash. Instead, set a fixed, modest amount you pay yourself on a consistent schedule, weekly, bi-weekly, or monthly, from your profit account, just like an employer would pay you. This is what actually ends the feast or famine feeling. Feast or famine isn't really about how much you earn. It's about how unevenly you spend based on how much recently landed. When you pay yourself the same, Predictable amount regardless of whether last month was huge or quiet. Your personal life stabilizes even while your business income fluctuates. The business becomes the thing that absorbs the ups and downs. You don't. Say your income varies wildly, $2,000 one month, $9,000 the next. Instead of spending based on whatever came in, you look at your average monthly income over the last 6 to 12 months. Let's say it averages out to $4,500, and you pay yourself a steady $2,800 every month from your profit account, enough to comfortably live on. In the $9,000 month, the surplus stays in profit as a cushion. In the $2,000 month, that same cushion covers your paycheck. You stop feeling every swing in client payments as a personal financial emergency. The moment a client payment clears, transfer your tax percentage, whatever your accountant recommends, often 25 to 30% for most freelancers depending on your state and income bracket, into a tax account you never touch except for quarterly estimated payments or your annual return. Set a recurring reminder or use your bank's auto transfer rule, so this happens without you having to remember. Tax debt is the single most common source of freelancer financial panic, and it's almost always caused by the same thing: treating the money as spendable the moment it arrives, because nothing physically separated it from your other funds. When the tax percentage leaves your site immediately, you stop mentally owning money that was never really yours to keep in the first place. You invoice a client for $4,000. Before you do anything else, before operating expenses, before paying yourself $1,200 or 30%, moves straight to your tax account. When your quarterly estimated tax payment is due, you're not scrambling or dipping into rent money. The exact amount is already sitting there, untouched, because it left the second the payment cleared. Alongside your 3 main accounts, build a separate buffer fund specifically inside your business finances. Ideally 1 to 3 months of your average operating costs plus your fixed owner's paycheck. This isn't your personal emergency fund. This is your business's emergency fund, designed to keep your fixed paycheck flowing even during a genuinely dry stretch. Freelance income isn't just irregular in size, it's irregular in timing. Even great clients can pay 30, 60, sometimes 90 days late. Without a buffer, one delayed invoice can force you to skip paying yourself, which is exactly the kind of instability this entire system exists to eliminate. With a buffer, a late payment becomes a minor scheduling issue instead of a personal financial crisis. Let's say your fixed monthly costs, operating expenses plus your own paycheck, come out to $4,000. A 1-month buffer means keeping $4,000 sitting in a separate business savings account, untouched, purely as a shock absorber. If a client who owes you $3,000 pays 45 days late, you don't feel it. Your paycheck still goes out, your bills still get paid, and the buffer simply refills itself once that invoice finally clears. Think about a freelance graphic designer, we'll call her Maya, who spent 3 years running her entire business out of one personal checking account. Good months felt amazing. Bad months felt like freefall. Every April, she owed thousands in taxes she hadn't planned for, and she'd quietly panic and take on rushed, underpriced work just to cover the bill. The year she finally split her accounts, operating, tax, profit, plus a slow month buffer, everything changed, not because she started earning more, but because she stopped being surprised by her own money. Her income was still irregular. Client payments still came in unpredictable chunks. But her paycheck to herself was steady every single month. Her tax bill was already sitting there, fully funded, when it came due. And the first time a client paid 6 weeks late, she didn't panic. She barely noticed, because her buffer covered the gap without her having to think about it. That's not a story about earning more. That's a story about a business finally running like a business. Let's recap the system. Separate your business account completely, split every payment into operating, tax, and profit the moment it lands, pay yourself a fixed and predictable amount, automate your tax percentage before you ever see it, and build a buffer that protects your paycheck from late or inconsistent clients. None of this requires earning more money. It requires treating the money you already make like a business owner treats revenue, not like a personal wallet that happens to have a business logo on the checks. The freelancers who feel calm, stable, and in control aren't the ones with the biggest income. They're the ones with the clearest system. If this is helping you rethink how you handle your business money, hit subscribe now so you don't miss the rest of this series, because this is just the foundation. Subscribe if you're serious about running your business like a business instead of living invoice to invoice. And I want to hear from you in the comments. What percentage are you currently setting aside for taxes? Or is your tax account currently non-existent? Be honest. Next video, I'm breaking down exactly how to calculate your specific tax percentage based on your income and state so you're never guessing again.